And my next guest is not buying the tech dip. Just went overweight utilities, saying it's time to invest in the tortoise, not the hare. Joining me now is Savita Subramanian, BofA Securities head of U.S. equity and of quantitative strategy. And Savita, the hare is the tortoise is handily winning already this year. I think utilities, as Mike Santoli pointed out in his weekend column, are trouncing the chips and other sectors of the market.
Indeed. Yep. And I owe this to my former boss, Rich Bernstein, but he published this chart back in the 80s and the 90s and the 2000s that shows that the total return of the S&P Utilities Index is almost always neck and neck with the total return of the NASDAQ. And you don't think of utilities as being this great, kind of source of alpha. But the truth is just that reinvestment of dividends is a powerful way to make money. And I think that's going to become much more important in the years to come. So it's interesting because if you look at the market returns over the last 10 to 15 years, it's been all about multiple expansion, which I would call the hare. It's like kind of the fast growth stories. But you've got these compounders that are just plodding along, and they tend to keep up. And I think we're at a point where the tortoise could actually overtake the hare in this derby.
Some of the people were questioning whether utilities have done well because of the AI narrative, because it's meant such demand for power generation and so forth. So I'm so glad that you mentioned this chart from Rich Bernstein, that for this is not a new story, and there might be an AI, piece of this, but actually it's a long-standing kind of relationship.
Yeah, there are differences, and I think the power story is fueling some of the strength in the sector. But think about it. If the Fed is likely to cut more aggressively on the short end of the curve, all those dollars in money market accounts are going to see less of a yield. They're going to be interested in stocks they can live off of. These are mostly retirees that control the bulk of household net worth. And, utilities have been a mainstay of retiree portfolios. They're maybe a lesser weight today because of all this excitement around tech. But I think we go back to that sort of old-fashioned, dividend yield, dividend growth theme. The other sector that I think is really interesting right now is real estate. Real estate has had a great run. You don't think of real estate as the tortoise. It used to be this very low-quality, risky sector.
Exactly.
But the key difference is, so today, I would venture to say that real estate has grown a lot more high quality. And the reason I say this is if you look at the number of companies or the percentage of market cap in that in the real estate benchmark in the S&P, 70% of it is considered, predictable, low earnings volatility, much higher quality than it used to be back in 2008, where it was only, 30% high quality. So lots of shifts have happened since 2008. And I think looking for quality and yield, you'll find it in utilities, which is more obvious, but you'll also find it in areas like real estate, like financials, other areas of the market that could surprise you in terms of their adjustment in quality.